the way out of a debt bubble is not by adding more debt, it's by...
There's like this one thing every Bitcoiner is familiar with, and it's...
I believe that it's a hedge against money printing, but the question is, do we have a lot of money printing?
Ansel Lindner, an economist and veteran Bitcoin researcher, hosts Bitcoin and Markets, one of the longest-running Bitcoin podcasts.
His work focuses on Bitcoin's macroeconomic impact, forecasting key trends like de-dollarization and demographic shifts.
Lindner's unique model blends free market economics with digital technology, offering insights into Bitcoin's role in the evolving global economy.
You, however, seem to have a different take. The question I really have, will this credit bubble ever burst?
In Europe, you never really recovered from the great financial crisis. That's not a recipe for a booming economy.
Isn't this blasphemy?
I didn't actually connect those two things until just now.
Hey Ansel, cool to have you back on the podcast after we already recorded this one session, but due to technical difficulties, I think it didn't work out in the end, but happy to have you back and now do the proper episode. How are you? How have you been?
Yeah, Pascal, good to see you again. We'll get it all squared away this time. Happy to be here.
Cool. So maybe can you quickly introduce yourself to people? Where are you from? What are your interests and why are you in the Bitcoin sector after all?
Okay, Ansel Lindner. I do a podcast called Bitcoin and Markets. Been doing it since 2016. Have a small but very loyal fan base, and I'm kind of a contrarian Bitcoiner. I came to Bitcoin from the gold bug side of the house, sound money side. I was an inflation advocate, or I thought inflation was going on really. And then as I was in Bitcoin and I learned more and more, went through post GFC into COVID and central bank policy and all this, I started deep diving into the global financial system and how money actually works. And I have come to several contrarian opinions here. And that's kind of what I'm known for at this point.
Yeah, exactly. Yeah, the contrarian takes, exactly. That's also these takes. That's also what caught my attention. So yeah, I would like to maybe talk about a few of these. So maybe to start it off, there's like this one thing, every Bitcoiner is familiar with, and it's Bitcoin is the hedge against money printing. That is something almost every Bitcoiner probably believes and agrees on. But you, however, seem to have a different take, right?
Yes, I mean, I believe that it's a hedge against money printing, but the question is, do we have a lot of money printing today? And so that's where I differ. I would say that overall, we are in a deflationary scenario at the end of a very long credit bubble going back decades. And while we have periods of reflation, the overall trajectory is towards a deflationary outcome for our current financial system. That is a global financial system that touches every country, every central bank, and all business, everywhere. And that is a big difference. Is it going to be inflationary end or a deflationary end? So I come down on the deflation side.
Mm-hmm. And why would you say are we in this like overall deflationary type of scenario or environment, So like, because people usually think we are on the way to hyperinflation, inflation is happening 2 or even more percent a year, and you're now saying, no, the backdrop is something else. And it's actually that there's this deflationary tendency. Can you flesh this out for us?
Yeah, there's many different ways or things that we can talk about in this regard, but the overall scenario is that, after World War II, we kind of entered this Goldilocks period where we had capitalism on the rise. The United States was somewhat of a benevolent hegemon, forming the UN, forming the IMF, forming the WTO, all these international organizations. Global credit exploded. Then we had the end of the Cold War. Global credit and globalization expanded even more. And so that is all inflation. We have 50, 75 years of an inflationary boom in the world. Just look at all of the different graphs. A big one is population. It's just a hockey stick, or you can look at poverty at the same time, and it's an inverted hockey stick. We just live in this bubble, everything bubble, but I take it to the nth degree that This is an everything bubble that has been going on for 75 years. And now, as we're at the end of that, we've run into diminishing marginal returns. The debt world is saturated with debt, and the way out of a debt bubble is not by adding more debt, it's by liquidating the bad debt. So, and if everything's debt, then everything is going to be liquidated. So that is what we're fighting against. That's what the central banks are fighting against. They're fighting against this tsunami of the end of a giant credit bubble that we have built over decades.
Interesting. So as I understand you, you were saying like, this economic growth that we had, it was mostly probably accelerated and really pushed for by banks, because these are the ones creating the money today. It's sort of like debt-based money, credit-based money, and obviously they are the money creator in today's system, and they do it out of probably market demand. If there's opportunity, then they extend credit and create debt. That's how inflation then works. And if there's no opportunity, no inflation, no debt is created. Is that correct?
Yeah, in a deteriorating economy like we have right now, you have banks raising lending standards and borrowers actually lowering their own demand. You can see this in the Fed's senior loan officer survey, where they go out there and ask the senior loan officers, are you tightening standards? What about demand for your loans? And they seem to be inversely correlated. So as standards go up, demand goes down, and vice versa. So yeah, in the last 75 years, you can say demand was very high and standards were relatively low. Now we're going into a period where lending standards are going up and demand is going down, because if you're a business owner or an individual and you're going out there to get a loan, you only will get a loan if you think you can pay it back properly, right? And so if you see your business opportunities getting worse, you're not going to take out more loans. And so credit creation slows down naturally with the expectation of how you see the market. It might not even be an expectation. It might be, I physically am having a hard time meeting my current budgetary limitations. And so I'm not going to take out new debt. So you see, as the global economy deteriorates, demand for debt deteriorates as well. That is why the central banks come in and they stimulate demand, trying to get people out there to borrow money, get people out there thinking, oh, the Fed has your back. That allows the market to get kind of back on its feet and start having a rosier picture of the future. If people think there's going to be inflation coming, they're going to act as if inflation is coming. That's what the Fed thinks. They think it's kind of a self-fulfilling prophecy, and they are here to psychologically manipulate the market into getting back on its feet. Hope that makes sense.
Yeah, I think it does, because if I understand it correctly, then you're kind of saying, well, yeah, the central banks, what they're doing is really they're trying to keep the system from deflating, and that's why you have this period of reinflation, where they're kind of stepping in, and try to, if shit hits the fan, that things don't spiral out of control. And that's kind of then what is also seen in terms of this is QE and all these other packages that they have been coming up with, and sometimes people then Bitcoiners rush to the conclusion, oh, this is all money printing, and it's going to be crazy. Whereas it's actually just trying to keep a system which is already or has been inflated from kind of deflating, and that's where you're coming in with this argument, we're fighting a tide of or a tendency of deflation, and that's why that's also important to understand, right?
Exactly. Yeah. And just think in Europe there, you never really recovered from the great financial crisis. And so you can kind of feel out there that this is, we're moving in some sort of deflationary trend. The great financial crisis was kind of the culmination of everything. And now we have been sliding downward ever since. And we can't quite get back to sustainable growth in any way. So, yeah, exactly. That's what I would say about that one.
Yeah, probably because this marginal productivity of debt that you already also mentioned, is really decreasing and declining, and so you're fighting this kind of tide that is going ever or that is going back, and you can't do anything about it, because it's just like, the more debt there is, like the marginal utility that another additional unit of debt is creating is just decreasing. And at some point, this is going to get hollowed out ever more. And it's going to be interesting how this is met. This is also probably because like central banks have to go ever harder on these like reinflation policies, and try to step up the game. And that's then again why people think, okay, it's getting ever harder, and
Right.
and more inflation is around. So I think this sure.
Yeah, I just have something to add to that. So yeah, it's an exponential nature, and people see the exponential nature in credit. They keep adding more and more debt. They don't see the exponential nature in the diminishing marginal returns. So you have more debt burden on less productive debt. That's not a recipe for a booming economy, or an economy that feels really good and is overheating or anything like that. It's a recipe for an economy that's worried about the future. And so as you get more debt and diminishing marginal returns, you see money start flowing into certain assets, the safest assets, the safest type of assets, and the most creditworthy borrowers. And that happens to be why we talk about asset price inflation. So all this exponential debt has to go somewhere. Well, it gets funneled narrower and narrower into specific assets.
And that's probably what's so interesting about Bitcoin, I would say, because like it is this fastest horse, and then it is sort of an inflation net in the sense of, if like debt creation is going well and banks are really binging on debt money creation, like everything seems to be Goldilocks and everything seems to be good. Maybe just as we're right now, everyone is like celebrating 66K, I think we just hit, and people are like, oh, we're full risk on again, and that's then Bitcoin is an inflation hedge in these type of scenarios, but you just have to be aware of the fact that probably things can turn around again. And overall, we're in this deflationary backdrop, and that's, I think, is something that you would say as well. Bitcoin is also well positioned to be profiting from such a scenario, right? When things turn around and we really do enter this deflationary spiral.
Yeah, and I mean, it's kind of all roads lead to Bitcoin, whether it's inflation or the ultimate kind of deflation. I had another point there as you were talking, but I forgot what it was. That inflation, deflation, they're different at all different parts of the world. We talked about this last time when we first recorded and had the technical difficulties. You might have hyperinflation, say, in Turkey, but you have deflation in China, right? But if you have some asset that is an inflation hedge and a deflation hedge, it's a win-win no matter what. So again, all roads lead to Bitcoin. And that's why Bitcoin, all roads would lead to gold. If Bitcoin were never invented, we would be looking at a scenario right now where gold was pumping. So the gold bugs were right. Okay. The gold bugs were right originally, but now they're wrong because Bitcoin's here and Bitcoin's better than gold.
Mm-hmm. Yeah, exactly. It's probably, as I said, the faster horse in the end, and they're both going to be profiting from this. Bitcoin potentially like disproportionately be more, but both are kind of created for these two type scenario, where we have the inflation hedge as well as the deflationary hedge. But can you maybe flesh this out for us? Deflationary hedge, what does it mean? last time you were hinting to this counterparty risk thing, maybe you can elaborate on this.
Yeah, the banking system is a complex web of lenders, borrowers, tri-party, a trusted third party within the repo system. So there's this web of trust that is lubricates the global financial system. And when things start to deteriorate, trust breaks down between these banks. And really it breaks down because everybody knows that the other person, the other party to the transaction, depends on all these other parties. Like there's nobody that's standalone with good assets. Everybody is just as broke as everybody else. And so, the deflation is when those things stop moving, when money stops moving and people start defaulting on their debt. So default if lending is credit creation, default is credit destruction. And so you start, that's where the deflation happens. And then you can have the contagion. Remember in 2008, they said, "Oh, we have stopped the contagion in the subprime market." Well, no, it was actually in the bank's balance sheets, and so it spread all around the world. So this type of contagion is what causes deflation through defaults, and it is kind of once it gets started, it's very hard to stop. That's why you see extraordinary measure, new novel measures tried by the central bank all the time. Just looking at 2020, was it 2023, March of 2023, with Signature and Silicon Valley Bank and stuff, they had all these new bailouts that they tried to do with them. I mean, every single crisis seems to have a new facility that the central bank brings on, some new tool. And that's what they have to roll out to stop that contagion from getting away from. It's kind of like antibacterial resistant bug, a super bug in the hospital. You know, it has been treated over and over by the same medicine, and it becomes resistant to it. So they have to come out with new medicines or new antibiotics. And so the central bank has to come out with new policies all the time to try to fight this and keep this from spreading, the contagion spreading.
Mm-hmm. Yeah, very interesting. I think it's interesting that you bring up these like the example of the banking crisis in 2023. Exactly. You know, I think it was March 2023. You know, with Signature and Silvergate, and then also Silicon Valley Bank. I think, you know, and there, I think if I remember correctly, we saw Bitcoin kind of outperforming. You know,
Yes.
and serving as a sort of a hedge again. You know, and some people were saying, well, it might have been because of something else. There's not an immediate and direct correlation. And maybe this is even true. But I think, again, if you come from a theoretical standpoint, this is exactly what Bitcoin was created for. So
Yes.
there is kind of like a hint in this, you know, that in these type of scenarios, Bitcoin is made to flourish, right?
Yeah, that is interesting observation. Bitcoin initially dipped, if you remember. The first week of March 2023, Bitcoin dipped, I don't know what percent, 10, 15%. It bottomed. And then when people got really scared, Bitcoin rocketed 40% higher. We see the same sort of pattern in gold during the Great Financial Crisis. The first couple months of the Great Financial Crisis, gold actually sold off. It bottomed and then it rocketed higher. The dollar does the same thing. So if you go and look at all of these recessions and periods of crises, the dollar tends to dip initially, and then go higher to the next level up. And so Bitcoin followed that exact same pattern in 2023, which I think is very interesting. I didn't actually connect those two things until just now.
Yeah, true. I mean, that's Bitcoin's ambiguity, you know, which makes it also so interesting. It's sort of like you have this asset, you know, which is has all these risk-off qualities, you know, and traits, and that's why people probably flock to it in scenarios of stress, you know, and distress. But then it's also interesting that Bitcoin is this really liquid asset, you know, 24/7, just really liquid markets all over the world. And as you said, we saw the same with gold in, I think, the great financial crisis 2008, you know, where gold was initially sold off, probably because people were kind of, okay, I have to, because it's, again, back to the debt-based system that we are, you know, you're getting margin called, you have to kind of pay back your debt. And then obviously you liquidate something which is counterparty free and is liquid, and that was gold, you know. And probably when these banking failures hit in 2023 or in 2023, it was also again because Bitcoin served as this liquid instrument, you know, that you could kind of serve any type of margin call that you had. So that's just interesting, you know, that you have like, again, it's this dichotomy, so to say. Bitcoin is both there as well.
Yes, and Bitcoin has better characteristics of liquidity because it's open 24/7. During October 7th, with the Israel-Gaza thing kicking off, Bitcoin dipped on the weekend because it was the only asset class that provided the ability to sell and cover those things. So, yeah, very interesting. I like that.
Yeah, for sure. Well, I mean, if I have this in front of my mental eye, I would say I have this three type scenario. You have this risk on scenario, that we said, like if banks are binging on credit creation and everything is going well, they're extending credit, then probably Bitcoin is doing well because it's like the world is really pumping, and obviously everyone knows M2 is going up, and then that's why Bitcoin is kind of serving as an inflationary hedge. Then we have this scenario where you have the deflation, maybe in situation where it got too exuberant, and people are slamming the brakes, and that's then where like central banks have to come in and to kind of avoid this deflationary spiral from getting out of hand. And that's probably where Bitcoin so far hasn't done that well, because then we see like everyone is flocking to traditional risk off assets like treasuries, but then maybe in the aftermath, if things are accelerating again, Bitcoin is doing well again. But then the third scenario, and that's, I think, where both of us are going when we talk about this deflationary hedge scenario, is if the credit bubble would ever burst, like in a sort of apocalypse or endgame scenario, then people might be looking to things outside of this credit system. And that's where they would probably turn to gold and nowadays also to Bitcoin as their ultimate risk-off asset. The question I really have, will this credit bubble ever burst in an endgame scenario?
Oh man, lots in there. I would say that there won't be like some fiery contagion that spreads and instantly wipes out the system in a deflationary collapse, like in a day or something, because the banks can kick it down the road. The Fed can extend and pretend. But in doing so, they seal the fate, right? They don't allow creative destruction to happen to the bad debts. They just lock in the debt burden. They lock in the diminishing margin of returns on debt, and the economy will go into entropy. That's why one thing I've been saying for many years now is we will just grind lower inflation, lower growth. And even if though we don't go to like negative 5% growth, we don't hit like a major recession, say the Great Depression, where they had, significantly negative GDP growth. We're not going to hit something like that because we can't extend and pretend. But 0% growth for 20 years, like Japan, say, that's not fun. That's pretty much a depression as well. And if you want to get out of that, you have to change the form of the money. So that's why I think you're going to go away from counterparties. More and more people are going to move at least a portion of their investments into Bitcoin, into any different types of forms of Bitcoin. Maybe you can buy MicroStrategy. Maybe you can buy into Bitcoin mining. Maybe you can buy into chip fabricators. That's outside, kind of on the border of Bitcoin. That's a Bitcoin play in my mind. So you'll see the system rerouting itself as the entire system is going towards entropy, which I think is kind of interesting. But I wanted to loop back and touch on something that you were talking about there about, and if I go on too far of a tangent, let me know. But you said that if the economy is booming, Bitcoin will do well because it will get like this inflationary bid. But I think that's not true, actually, because the worst enemy of Bitcoin is a well-functioning credit system. If the credit system is functioning well, there's no reason for large pools of capital to go into Bitcoin. That the inflationary bid is going to be more of a different type of investor. So it's going to be the mom and pops, the everyday person. The lay person is going to try to protect themselves against inflation. It's going to be the gold bugs, but that's a very small portion of society. Maybe 5 or 10% of people are going to care enough, be smart enough to do that. It's the deflationary scenario that really can take Bitcoin to the next level, because large pools of capital with highly sophisticated investors, they are going to see what's happening and they are going to diversify into Bitcoin. So that's what I would add to that.
Yeah, very, very interesting observation, because like that's really what I'm struggling with, like to kind of understand where the demand is really coming from and which one of these is going to outweigh in the end, because I have the feeling, again, and I can feel it like anecdotally with my friends, like if things are going well and like people are feeling like exuberant and like there's a talk of the roaring economy and everything, I have all these friends coming up to me and like, okay, now I have extra cash to spare, where can I put it? Well, I'll do Bitcoin, because now it's the time, and I think they because they kind of still see Bitcoin as a sort of risk on assets, that's when they are going to deploy that sort of money, and that's maybe all the retailers. And as you said, like if things break down at some point, maybe these people who have not studied Bitcoin well enough are probably not going to discover it, even though they would need it in that exact time. But you maybe have other people, and it's probably the smarter money type, who's then going to like, okay, I'm not getting Bitcoin because like I think it's going to pump immediately, but because I need to get something which is counterparty free, and then one by one, like adoption happens as well, and maybe it's even the adoption, as you said, which is more a 0 to 1 adoption, which really changes things. But I see both scenarios, and for myself, I can't really make out which one is really the defining one. If you know what I mean,
Yeah, exactly. I think the large pools of capital, the deflationary scenario, I think, is the rocket fuel. The inflationary scenario is nice, and but it won't lead to global adoption. Global adoption has to come from the large pools of capital. So that's what I would say to take it to the next level.
Yeah. And I think we're seeing this happening already now, because I think you mentioned it last time. And I also read this paper by BlackRock, and these are the people who are managed like the biggest pool of money. Yep. And they have pointed out in their last paper that Bitcoin is not only a risk on asset, it is actually much more a risk off asset, because it has these qualities, and if BlackRock is kind of pointing to these like truisms, then it's kind of like, okay, it's the most connected, probably
absolutely
the people with the biggest money pools, who are figuring this out. So this can really turn the needle, right?
Yeah, what I loved about that report was in their key points right up front, they said that Bitcoin does not fit into the traditional risk on, risk off paradigm. It is something, it's a completely different animal. And that is what we've been talking about for the last 15, 20 minutes, is that Bitcoin is a completely different animal and doesn't fit into the box of all these other investment theses.
Yeah, and that's also what I find so like fascinating about Bitcoin, because you really have to study that thing, and BlackRock and the people around there seem to be doing this, and they figure it out slowly, gradually, but then they figure it out. Yeah. And I mean, it's the same with me. It was the same with you, probably. Yeah. It's going to be the same with other people. You figure it out by studying it, and then also by just kind of at some point, more and more people in these like deflationary events, like where the system is seemingly breaking down, and central banks have to go all in with this inflationary measure, that they take. Then probably there you have at the margin a few people who will discover it again, and like with every scenario and every hit, like more people will enter the system, and that's how it's going to grow in the end. That's for sure. Very interesting. I mean, maybe I would like to ask you this other question, because like Bitcoiners, they might be listening to this conversation and they're like, okay, these guys, what are they talking about? It has to be inflation. Yeah, I was always told it was inflation. And they're also, as it seems, hinting that central banks are not the ultimate culprit, So, isn't this blasphemy?
It is blasphemy. And now my podcast, I always give a disclaimer when I'm about to go on a rant. I'm like, all right, Bitcoiners, I'm about to blaspheme over here. But yes, the central banks, in my opinion, are not really in control. They psychologically manipulate the market. And this is kind of empirically true. If you look at interest rates and the Fed funds target range, Maybe the very short end, we're talking the 4-week, the 8-week, the 3-month treasuries. Those are more spot on with Fed funds. But once you get to like the 1 year, the 2 year, the 5 year, they don't obey the Fed's policy. The 10-year has been below the Fed policy pretty much the whole time that they've been holding stable. And also, if you look at it, interest rates move prior to the Fed moving. So if you just go back to 2021, before the Fed is starting to raise interest rates, what's going on with the rates? They're rising. They're already rising. And then the Fed comes in and starts hiking. Then the interest rates stop rising. The Fed stops. The interest rates start going down naturally on the market. The 2-year hit like 3.6%, and the Fed was way up there above 5%. Mm-hmm. And then the Fed comes in and follows the market lower. So the Fed isn't really in charge of interest rates. They're not really in charge of much. They are a psychological manipulator of the market.
Yeah, that's obviously quite a contrarian take, but I think it is interesting, because the philosopher in me and really the person who wants to figure out like how the world really works, and maybe that person is really interested in figuring this out. But then in the end, if I have my investor hat on, then I'm like, well, does it even matter, in the end? Because as an investor, you want to make money, or you want to position yourself as good as possible, and there again, it probably doesn't help understanding whether it's the central bank or not. In the end, I mean, you have to understand the system, and as you said, even though some people might be thinking, oh, central banks are the ultimate culprit, there's a lot of evidence that this is not entirely true. And then I think in the end it doesn't really matter, or at least like you really want to understand how it all works. And it kind of intertwines for sure, but it's just an interesting thing. But then Bitcoiners, go ahead.
Yeah, the Fed is a regulator, and they can change the rules. And so all of these bailout packages that they do technically are just changing the rules. And they say they wave the magic wand, and they say your balance sheet is now solvent. And that's supposed to stop this contagion, right? Stop the counterparty risk. Oh, I just got the central bank spell cast on me, and I'm solvent now, so everyone should treat me as solvent. But I mean, that kind of works, but not in the long run, right?
Yeah, it kind of works as long as people are believing in it, and it's sort of a self-fulfilling prophecy, which it is right now, I would argue, because like if central banks go out there and they speak a word of power, then everyone is like, oh, crazy. Yeah, they have spoken. So we have to abide by their word, But exactly as you said, maybe at some point it won't work anymore. And then it's good to have been there, kind of thought this thing through and said, well, maybe they haven't been that omnipotent in the first place, So that's certainly something you want to have considered.
And moral hazard, if you bail them out, and they don't correct the behavior that got them to that place, even though the central bank says they're solvent, you as a counterparty know, well, they didn't really fix anything. So they're probably going to have trouble in the medium to long term. Again, do we really want to do business with them? Maybe we should start thinking about being defensive, and then, oh man, that's when all hell starts breaking loose.
Mm-hmm. Yeah, I mean, this point of moral hazard, that's probably where I could still pinpoint some, or I wouldn't let central banks off the hook like entirely, because I would say, okay, moral hazard is this is something that they're kind of fostering through this, because they're trying to this reinflation mechanism all the time, and really avoid this deflationary spiral. That's where they kind of, probably are also sort of responsible, that this can is being kicked down the road, but that's maybe it.
And setting the rules. So they can set the rules for tier 1 capital. They can set the rules for the margin, the reserve requirements, all those things. They can bend those rules at their whim to manipulate the market. But this is I wouldn't let them off the hook ethically or morally. They are trying to manipulate the market, which I think always ends badly. But they do not mechanically print money like people think they do. They don't mechanically do anything in the market. It's all through psychological manipulation and rule setting.
Yeah, I mean, for me, eventually it's like this dilemma that like we as mankind have been in forever, because like if you want to probably create a system, a credit-based system was probably chosen by the market, as it seems to be a really efficient solution, so sort of like it is a market decision, but then at the same time, as I said, it's a dilemma because it comes with all these downturns, and then you're really at the point of am I now trying to manage this, and keep a lid on it as good as possible? But there again, I would say we're in a dilemma, because I wouldn't argue that any central banker has enough knowledge to kind of steer this and really kind of manage this, and that's really, I wouldn't want to be a central banker either, because, I just know it's hubris to kind of have to do what they're tasked to do, so yeah, but that's the dilemma I think we're in. I mean, speaking of a dilemma, that's probably where some of the Bitcoiners then would argue, okay, if you are not blaming central banks, you're not talking about inflation as something which is driving Bitcoin in the first place. So it really sounds like MMT people, because they are the people who are kind of like blaming banks and not central banks, and they're rooting for government and central banks to control the system. So what do you say to this?
Well, I have been accused of sounding like MMTers in the past, but fundamentally, and I'm not an MMT expert or anything, but fundamentally, what I understand about MMT is the government creates money. They are basically legally create this thing we call money, and that they can use this money to go out there and get full employment of not only labor, but resources out of the economy. It has no understanding of diminishing marginal returns on debt. So I would say that point is completely counter to what MMT people say. They do happen to sound, they have some good points around the way the global financial system functions currently. But that's not necessarily some universal truth about money. So I would say the way I look at it is, yes, the market has evolved into the current system, but conditions change and we can go back towards a commodity-based money without counterparty risk. So that's what I think is going to happen. And the government's not in control of that. The more the government pushes to try to keep us from going in that direction, the more we're going to want to go in that direction. And so it's kind of a self-fulfilling prophecy in that way. So that's where I would say I differ from MMT. Again, I'm not a MMT expert or anything like that, but just on these broad sweeps, that's how I differ.
Sure, exactly. No, but I think you made a great point right there, by saying like, they have a problem, or they don't see any problem with this marginal productivity of debt, that is probably declining, and they have a feeling like, yeah, we can always shift debt, the entire burden onto sovereigns, and then it's sort of like a black hole, and this is not going to matter, and they can absorb it all. And that's probably where I would disagree as well, that at some point something will have to give, and it's probably the market which is stronger than the sovereigns in the end. But
the sovereigns could try to take it all on board, but that's when hyperinflation happens, So the market is, like you said, you're trying to say that I interrupted you rudely, but the market is ultimately in charge. The government can't dictate some MMT fundamentals.
Yeah, exactly. Yeah, this was already stated by one of these Austrian economists, I think his name was Böhm von Bawerk, this Austrian guy. And he had this book, like where he's saying, like, in the end, there's the power of economics is really above politics. That's more or less how, when I paraphrase him, and that's, I think, he established this theory long ago, and it seems to have proven over and over again, But I think that the signal message that I would like to take people away from this is really, and I think that's where you pointed it out well, it's just so complicated, the entire world. And I mean, sometimes also these people who are called MMTers, or MMTers, they have something right as well. It's not that they're 100% wrong, and maybe they're analyzing the system in a great way and they have good points there, which doesn't mean that in the end conclusion they're also right. But I think this is really, I want people to take away also from this entire conversation, that because the world is not so clear cut and it's not black and white. I mean, there's so many different ways you can approach this, and not everyone has to think alike, because that's also where you then kind of get the most signal from, if we get to talk to people like you and others who have like contrarian takes.
Yeah, I would say that, that's a great point. People are right at certain different times under different conditions. But yeah, it's so complicated. What I recommend people doing is, instead of using your kind of framework to predict the future and say, this is how I understand money. This is what's going to happen, because they're doing X, Y, Z. Instead, look at what the market is actually doing. Observe what the market is doing. Try to understand why the market is acting the way it is. And then, only then can you maybe predict something about the future. So, don't start from your own thesis. Form your thesis around actual observations that are going on in the global economy.
Yeah, great insights. Thanks a lot. So maybe two last questions. This one question I already asked the last time when we were recording, so who is a high signal person that you would want to see on this podcast, and what topic or question would you ask that person?
Brett Johnson, Santiago Capital, or Santiago AU on Twitter. He is the author of the Dollar Milkshake Theory. He is also a fellow Nebraskan, both born in Nebraska. But yeah, he would be a great guest. And what I would ask him is similar questions to what you asked me. He has a better grasp on the international role of the dollar. So that's what I would ask him.
Great, cool. Yeah, certainly we'll try to consider him, and maybe at some point I can get him on the podcast as well. So thanks for that recommendation. Maybe last off, so where can people find you? Where can I send people? Just maybe drop it all here, and then they can go and check you out.
All right. Bitcoinandmarkets.com is the homepage for my content. I write a lot. I do live streams about 3 times a week on different channels. You can find that in my pinned tweet at Ansel Lindner for all of those links. I also am now a Forbes contributor, so you can be watching out for my Forbes pieces, and that's it.
Cool. Ansel, thanks a lot for all your insight. Ansel, by the way, what type of name is this? Is this a Dutch name or originally, or do you even know?
It's from all over. There is a Saint Anselm, I think, that is like Irish or something like that. But my dad got it from Ansel Adams, the famous black and white photographer from the United States.
Okay, I see. So it is a name that's known in the States, for sure.
Yes. If you go to Yosemite, those places, you'll see Ansel Adams photography all over the place.
Cool. Okay. No, it just sounded kind of Dutch to me, but great. Cool, man. Thanks for taking the time, and hope to talk to you in the future again. Have a good one.
See ya.
Bye.